ना ले लेते हैं. I just want to go to the washroom. I'm keeping here. Yeah. Yeah. Okay. Just. Sure. I just go to the washroom and start it. Initially, how I planned my phone
What takes you to Bauer? What takes you to the masterclass today? Looking at building something in this space?
Yeah.
Or already building something in this space?
Working on something.
Working on something. How old are you guys?
I'm 16.
16. Wow. I really get amazed by listening to people building something at the age of 15 and 16, because when I was your age, I was just out playing out in the sun. That's it, right? My summer vacations were all about starting playing in the morning, going back having lunch, and then going back again to play.
You do that also.
You do that as well, but you just don't do only that, right? I did only that when I was a student. But nevertheless, it's quite inspiring. So the institutions that I visit, right? I've visited Bauer, obviously, visited Mesa, visited several other institutions. Now I have seen that a lot of young people. So last weekend I conducted a session for UG students at Mesa, and spoken to NM students as well who are in the undergrad. Now what I've seen is that there's a growing wave of students who are looking to build up right from 15, 16, or join a startup potentially which is building up and then look to transition to entrepreneurship. And I see this growing, which is quite encouraging, because people and students are thinking right from the age of 15 or 16. And I'll show you, actually there are two investments that I've invested, really young chaps, about 14 and 15-year-olds, and they've actually built up a business which has a committed revenue of almost 1 lakh in year one, 10 lakhs order book in year one. So it's good to see all of that. Great, great. What is your name, sorry? Higher Creef.
Yeah.
What's your name?
Asher.
Asher. Tough names. What's it? Easy. Thanks. You are, sir? Bhanu. Of course, yes. Just that you were sitting and I was like, I'll come on this side. Okay, nice, perfect. No. I don't think there's any segregation as such. All right. Are we expecting anyone, or should we start? You are? Okay, just let me know when I should start. How are you guys doing? So you had sessions yesterday?
Yes.
And today, Saturday and Sunday. You guys don't have anything on the weekdays specifically? Okay. We went for kayaking last week, is it? Not kayaking, pickleball or kayaking, I'm not sure. Either of the pickleball. Okay, nice. How is it? Good. Nice. All of you guys went? Nice, nice. So only Shivangi is not here. Hans is also not here. Okay. Why is Hans not here today?
Hans is attending online. He went to his hometown. He had some.
He's gone to his hometown. Okay.
He's going to be back next week.
He is the tennis guy. Yes, I remember him as a tennis guy, right? Building something in the tennis space. Yes, tennis theory. Wonderful. Yeah. So you got sessions till 6 o'clock today. So after mine ends at 2. Then you got something from 3 to 5 and 5 to 7. So Ratnakar is taking the session after me. What about after him?
It's an online class by Havish online.
Havish. Okay. What's the class on?
So it is on data cleaning and transformation.
Data cleaning and transformation. And what topic is Ratnakar taking today?
Fundraising and investor management.
Fundraising and investor management. Oh, it will be a good segue actually to what I'm covering today. So what we'll be covering in the session at 12 o'clock is basically the practical funding stages of how you start from actually thinking, how does a venture capital fund start from looking at an idea to ultimately investing in it. Right, so we're going to go through the end-to-end processes, the practical processes of funding, and then funding and investor management. Fundraising and investor management would potentially be a good segue to that. So my course is largely more of bringing the industry to the classroom. So essentially how we did it at 6 Sense Ventures, how we looked at a deal right from the start to ultimately disbursing and then monitoring it. Idea is to bring that to class. I think that should be a good segue to how you can look at then fundraising and investor management post that. That's a 2-hour session, right?
Yeah.
Okay. And this is his first session for you guys, or he's taken an earlier session as well? Ratnakar?
No, the first session.
First session today. Okay, nice, wonderful. They've demolished this building. Wow. Sorry? Sorry?
Did you get to work?
No.
There was
center is park. They're rebuilding the entire IT park.
They're building an IT park here.
I mean, it's already there. They're building new building. I mean, they're constructing new buildings.
Oh, so this full building will be brought down and they're building up a new building. Oh.
Yes, you can start class. Someone is on the way and the live stream already going, so they can join.
Okay, perfect. So they can join midway. All right, guys. So what we will do is we will get started. Anyone who wants to join can walk in, and I also understand that there is a live stream that is going on, so they can join in on that as well. Typically, in a class where I conduct a session, which is a part of a course, I close the gates 5 minutes after the class starts. Idea is that I shouldn't disturb the people who are already sitting in, shouldn't disturb me, and as well as anyone walking in after 5 minutes perhaps might lose the flow. But given that we are not here for a session or a class today, and also not as part of a formal course, I will not be doing that. So as and when people come in, they can simply walk in, sit, and be a part of this masterclass, right? So perfect. I've got an hour with you guys. I've been told that we're expecting a bunch of people who are looking to pursue an undergraduate either this year or next year. I had a chance to speak with some of you as well. I was also told that the lead students will also be here. So what I've done is I've tried to tailor the content, not try to, but I've tailored the content in some form that all of you guys can have some value addition from it. Ordinarily, if you guys weren't there, I would have taken a course which had some overlap to what we discussed, because last time what we discussed was essentially the starter to a masterclass in private investing. But what we've done now, what we will be doing today is we'll be covering the complete end-to-end of what venture capital and venture capital investments look like, right? So we will get started, and before that, let me introduce myself and who am I and where do I come from, to just appreciate where are we going and what I'm speaking and why am I speaking what I'm speaking, right? So for that, let me give you a perspective of where I come from, give you my introduction, right? So my name is Siddhant Gupta. I am the founder of a platform called Skills On, but the journey that led to Skills On, right? Skills On is something which I started last year, but the journey that led to Skills On is something that I am very happy and excited about speaking, and also excited about the learnings that I've picked up on the way. An idea is to bring these learnings to you in the classroom today, right? Whether it is in the form of a masterclass or a course, right? So academically, I am a chartered accountant. I had a rank, All India rank 35 in my CA examinations. I graduated from the Indian School of Business with a gold medal in MBA in finance and marketing in 2021, right? A bit that was covered about me, right? So finance is something which I love because I had done my CA and I thought that finance would be a good natural progression to do at ISB. So which is why I chose finance, and marketing because I love to wake up in the morning and look at ad videos, and I thought it's an interesting class to be a part of. So I chose marketing as well, right? So I felt marketing was slightly easier than finance. So then I thought marketing and finance will go hand in hand. So that's about me on the academic front. I worked at Deloitte for about a year in the financial modeling role, where we worked on advising a lot of clients across the globe on building financial models, inspecting financial models, and also helping them build visualization dashboards in softwares like a ClickSense. So we built a visualization dashboard for a company called Novartis, right? A very, very big company and a very big project. So it was about a 3-4 month project that I was a part of. Post that, I worked at Arthur D. Little. So this is post my MBA, where I joined Arthur D. Little as a management consultant. So ADL, or Arthur D. Little, is the world's oldest management consulting firm. It advised the first government of India back in 1947. Then it shut shop somewhere in the 2000s, and back into 21 when I joined ADL, it was just getting started, right? So Arthur D. Little was just getting started in India, and I joined the founding team at ADL essentially, where we it was pretty exciting because it was more like joining a consulting startup back then, right? So pretty exciting journey. I was there for about 12 months. After that, I got an opportunity to be the vice president of investments at Sixth Sense Ventures. Now, Sixth Sense Ventures is India's leading domestic focused consumer venture capital fund. So we manage almost about $500 million assets in consumer investments, anywhere from seed to Series A to growth. We look at all of those investments across the nook and span of consumer in India, right? So if you look at any companies like a Bira, a Bombay Shaving Company, Parag Mill Foods, Noble Hygiene, Wonder Chef, we would have invested in all of these companies, right? So we write checks anywhere from 50-100 crores to almost about 200-250 crores in all of these companies, right? So I led about 3 deals there at Sixth Sense Ventures as the vice president there. The first deal was in a company called Procmart, which was a $10 million deal, and we did a Series A investment. It was topped up by Nandan Nilekani as part of his ventures called Fundamentum Ventures, and a couple of players like Edelweiss also pitched in. So all in all, was managing about 300 crores worth of deal making at Procmart. $10 million is what we primarily invested, and which is the investment that I led there. And apart from that, I also led investments in Parag Milk Foods, and we were just on the verge of making an investment in Stalem Industries. For some reason, that did not come through. So altogether, about 3 deals that I was leading. I also manage a corpus of about 600 crores there. So our fund manages about $500 million assets. Of that, about 600 CR is something which I personally manage. So that included companies like Bira, Altigreen. We also had Nemes, which is based out of Hyderabad, but that was managed by the other deal team. So managed about 600 crores of investments there. Now my idea of coming to Bauer is essentially to bring this industry to the class, whether it is in the form of this masterclass or whether it is in the form of any course that I would be typically conducting. So the course that I conduct for lead students is industry perspectives, and the course is just what the name suggests, right? So perspective from the industry to you. So for all of you guys also looking to build something and get into UG at some point, maybe this year or next year, idea is to take you through the end-to-end dynamics of how private investment actually works, from how venture capital funds are structured, to how they invest, to what we look at, to essentially how do you monitor the companies once you've invested in, and also looking at some trends around how investing is spanning out across India as well as the world, right? So quickly, we will get started. I will not pause a lot for questions during this 1 hour because I've got a lot to cover in this 1 hour, but in case you got any questions, you feel that the jargons are getting a little more technical, just feel free to stop me and ask me then and there itself, right? Don't wait till the end. That would be my suggestion. All right. Perfect. So let me continue. Let me also give you some glimpse into some more interesting students that I've met at Narsi Monji College. I've spoken at several events. I've also been a shark at several Shark Tank competitions across India. LNM IIT, Don Bosco Institute of Technology. These were certain institutions where I was a shark at all of these competitions as well, right? As I was telling you, I've got 2 cute investments. One is in an idea by a 15-year-old Amok Fanda, and this is one of the primary reasons of having this here today was also, I think, the relevance is very high because you said that you're 16 years old. I think all of you are 15 or 16 year old, right? So I think it's quite relevant and quite motivational for me as well when I see these guys at the age of 15 and 14 years actually building up. So Amok Fanda is building a venture called Veda Candies, and which is basically jaggery based candies, a first year turnover of about 1 lakh rupees. And Abhiraj Hada is building something known as a Flash Nova, which is into digitally customizable nameplates, right? And he's got an order book of about 10 lakhs in the first year. So pretty amazing. The idea of backing them is not as much that the ideas may be innovative, but the fact that they're thinking at this stage is really amazing, right? And that's the reason why I typically back them as well. I also posted about this. I was happy to get some validation from thought leaders like Sunil Shetty, who's actually doing a lot of work on the startup space. I'm actually personally connected to him as well. So quite interesting. And obviously once he writes, people listen, right? So quite interesting to get validation from these folks as well. Right, so perfect. We will get started. We will look at how do we decode private investments, right? Which is essentially the masterclass that we are all here for. Right, so without further ado, this is what we will be covering today. We will be first looking at the context. Why does venture capital actually exist? We all read about it. Oh, VC funds, VC firms, jobs, etc., etc. But why does venture capital actually exist? What is the buzz about, and what is the need for venture capital, right? Then we'll be looking at the map of venture capital firms. What are the type of VC firms out there? How are they structured? How do VC firms earn money in the first place, right? We know that, okay, investors put in money, they get 10x, 12x, 100x returns. But how does a venture capital fund earn money, right? So we will be looking at the monetization model as well, which essentially would be something new for you guys as well that we will be covering today. And obviously we'll be looking at the traditional OpSpot matrix, not traditional, but a signature OpSpot matrix that we've developed. So this is an in-house creation matrix for which we've already filed a patent, is in process, right? So looking at essentially a matrix that will give you a structure of how to evaluate companies and sectors with 98% accuracy, right? 2% because there will be some nuances which I will tell you while taking you through the matrix, but we will be looking at that as well. And then how do you make the investments? What are the concepts that you should typically know? And then certain trends around India, global, and the ideas that you should be aware of, right? So perfect, let's get started. We will set the context of getting you through the basics. So at the very basic, right, if I start with a question, what is venture capital? And if I break it down, right, if I break it down into the literal 2 words that are there out there, venture capital, right? So it is essentially capital to a venture. capital to a venture, right? That's it, right? So giving capital to a venture. Now, what do you mean by capital to a venture? Capital is just money, right? So you're giving money to a venture. So what is really new about it, right? Because ever since independence, and even probably before that, we had the barter system, we had money, so the money has evolved. But the fact that businesses need money is nothing new, right? So why has venture capital become the new buzzword out there, right? Why do you really need venture capital in the first place? So let's decode this, right? And that is essentially what we are doing when you're decoding private investments. So let's start from scratch, okay? How do businesses raise money? Two means equity and debt. Clear? Equity and debt are the two ways in which we raise money. So one is equity. I put my own money into the business, and the second one is debt, right? I take someone else's money, predominantly a bank's money, and put it in the business, right? Two ways in which I earn money. As simple as that. So if it's as simple, then what's the catch? But there is a catch, right? And the catch is this. When you sit back and think and introspect, you will realize that how much money can you really put? Now, even if you are a Mukesh Ambani, okay, a Mukesh Ambani will have a different limit. We guys will have a different limit, but everyone will have a limit. Everyone will have a limit to how much you can put. For example, Mukesh Ambani could be at 20,000 crores, to which he would put to a new business idea. For us, it may probably be 20,000 rupees, for all you know. Right? So there will be a limit to how much money you can put in your own business. There will also be a limit to how much money you can borrow. Now, banks do not have unlimited money or infinite money. They will not continuously give you money because they will look at your performance, they will look at several other parameters, and there will be a cap. Right? You cannot possibly borrow beyond a certain limit. Now, let me park that, right, and give you a second perspective, and then I will bring both the perspectives together. Can someone tell me what this graph is? Which goes from 471 to almost 1,60,000. Number of startups, that's right. From 2016 to 2024, not very old. Past 8 years, the number of startups from 500 to 1,60,000. This is translating to almost 4 startups every hour. So now, when I'm speaking to you for the next 1 hour, we will already see 4 startups being born in India. The growth rate here is almost 100%. You've got a 90% year-on-year growth rate, right? So if essentially the number of startups are doubling every year, right? 100% growth rate means doubling every year. So now, the key question is that on one side, there is a limitation of equity and debt. On the other side, you've got so many startups being born in India. So the question is there enough own money? There is not. So there is no enough equity out there to be funding these startups. Is there enough bank money? There isn't. Right? Even the banks have limit. So even if you see startups growing at 90% year on year, who will fund them? Because founders don't have enough capital to fund themselves. Banks do not have enough capital either. And that is where you have something known as an external own capital, right? That is something you have, that is where you got something known as external own capital, and I will get to what that is in the subsequent slides, right? Because the nuance that we are building here is that equity will never be enough, and a debt will never be enough, right? Because for a loan, bank will look at past performance, so there will be a limit on the debt, there will be a limit on the equity, right? And that is where something known as an external own capital comes in. What is external own capital? That is other people's own money. So for example, you look at the big guys. Now let's delve deeper into this external own capital. We know that startups are growing, equity is not enough, we know that debt is not enough, right? So we then bank on other people's capital, right? And then other people's capital also has several layers to it. Let's understand that, right? The first layer are angel investors, which are basically individuals with the money, right? You got individuals with the money, those are the big players. Who is he? Kunal Shah, again founder of Cred, he also invests in personal capacity. Who is he? Anupam Mittal, I had a chance to meet him last week, founder of Shadi.com, right? Again invests in personal capacity. Who is he? No? Kunal Bal, Titan Capital. So he runs a VC fund or a fund basically, which is called Titan Capital. But what was he doing previously? How did he shoot to fame? Snapdeal, right? So he was a founder of Snapdeal. Who is he? Yeah, how did he shoot to fame? Paytm. Yeah, so all of these guys invest in personal capacities as well. So angel investors. Who is he? Benny Bansal. And how did he shoot to fame? Flipkart, right? And he started his own venture firm called 3 State Ventures, and then he's also started his own venture recently, right? And he's got his own fund to actually invest in the venture. So a lot of these guys have made money, and now these guys are sitting with the pool of money. So your equity is out, your banks are out. So who do you go to? One of the guys you could go to are these sort of guys, right? And just an example, there are so many people out there who are actually giving you money. Here are typically angel investors. Then the other ones are companies with the money, right? Typically the corporates, right? So this is Unilever Ventures. You would have seen that they acquired a company called which one? Recently, anyone? Minimalist. They paid about almost 3,000 crores for acquiring Minimalist, right? So Unilever Ventures is the venture capital arm of Hindustan Unilever Limited. Which one is this? Any guesses? Unilever Ventures is pretty believable, right? Which one is this? Pretty evident from the name, but this one isn't. So this is Google Ventures, right? So basically invest in a lot of tech-based startups. Every company has a corporate VC arm. Which one is this? This is Microsoft. So Microsoft has its own venture capital arm as well. This is Qualcomm Ventures and this is Intel Capital. So every company you think of today is now diversifying into an added pool of capital, that is your venture capital. So they all are sitting on piles of cash. Do you know that Apple sits on loads and loads of cash? So the amount of cash that Apple has on its balance sheet, and I will leave you with the thought, in fact, when you go back home today, go and look up the amount of cash that Apple has on its balance sheet, right? Huge cash. So in fact, even companies like Zomato, right? Now Zomato on an overall basis is profitable, but if you go deeper into the financial statements, you will realize that Zomato as its business is actually not it's not profitable. It is not making profits. Why is it profitable? Is because it has a huge pile of cash that it has parked in fixed deposits. The fixed deposit is earning interest, and that interest is making sure that Zomato as a whole is profitable. So there is this whole other income element that is making sure that Zomato is profitable. Now a lot of companies are looking at diversifying the uses of this cash and looking at investing this cash in a lot of promising startups across. And that is why you see a lot of corporate VCs out there as well. Right? And then you've got families with the money, the big guys, right? Big families. So you had individuals, you've got corporates, and then you got families. Who is he? No. Harsh Mariwala is quite old. I mean, he's not that young, right? I don't think he has any black hair as well now. Yeah? Who is he? But close. His son, right? Rishabh Mariwala, right? So Rishabh Mariwala is running a venture called Sharp Ventures. Again, family money, Marico family money that he's looking at investing in a lot of startups across India. Who is he? Azim Premji, running Premji Invest. They were co-investors with us in a company called Jiva, which is doing phenomenally well, right, into silver jewelry. Who is he? Yeah, what does he do? Upgrad. And now what does he do along with Upgrad? So he runs a venture capital fund called Unilaser Ventures, which invests across media, entertainment, and a couple of these companies and startups. You guys didn't know about this, right? Not a lot of people know about this, that all of these guys have actually set up venture capital arms to be investing in a host of companies across India. That is the opportunity that India has presented. Who is he? Narayan Murthy. Why is he famous? Infosys. Do you know that he's running something called as Catamaran Ventures? So Catamaran Ventures is something that invests in startups across India as well. So, which is why, right? So this is all post-retirement, so to say, stints of a lot of these professionals who've now graduated from being top-class professionals. They've lived their life of taking Infosys to the next level of growth, and now they've not really retired from Infosys. They are still active shareholders or maybe passive shareholders, but in the next stint, in the second innings, they're essentially looking at building up funds and looking at powering up startups across India. Right? Who is he? Mohandas Pai. Why is he famous? Manipal. What else? So he also was a part of Infosys long back, right? So one of the early founding team of Infosys. He was a CFO of Infosys, if I'm not wrong, back then. And what else is he doing right now? He's Pi Ventures, and he's running something called as RN Capital, which is again investing across the startup domain in India. Who is he? Nandan Nilekani, again Infosys, and running something called as Fundamentum Ventures, right? So these are essentially guys which are sitting on piles of money, good loads of cash, and looking at meaningfully deploying them across the host of startups in India. And then you got the traditional funds, right? Venture capital funds where Sixth Sense Ventures, where I come from, you got Sequoia, you got Axel Partners and Bloom Ventures, for example. And then the bigger funds, right? After your venture capital funds, you got the private equity funds, which are essentially the big funds with the money, right? You've got the likes of GIC, you got Carlyle, you got Warburg Pincus. So these are all the big funds with the money. Now, the way a VC fund operates and a private equity fund operates in terms of the structure, in terms of the monetization, is more or less the same. Right, just that private equity funds would write bigger checks and they will have bigger control on the companies that they're investing in. But a smaller fund like a VC fund would typically invest smaller checks and the control would be not as high. Right, so typically a private equity player would be a very, very big player and doing very few deals. They will do a few deals of, let's say, 500 crores each. But a venture capital fund would do probably 100 deals of maybe 1 crore each. Right, so that's where a venture capital comes in, slightly at an early stage, and private equity comes in at a very, very late stage. Right, so for all of you guys who are founders going to build up, the playbook essentially is firstly see if you really need money, if you want to raise money, right? If you do not want to raise money, that's great. Zerodha is an ideal example of being bootstrapped. But if you do want to raise money, the ideal way is to go and start from an angel investor, look at a set of family offices, then transition to a VC fund, and then look at a private equity fund. The end game, right? The end game is you get an IPO or get a private equity fund just before an IPO to ultimately give it a set of control that they would typically want. And then you continue to run the company. So maybe after 9-10 years when you've already grown enough, you can then say that, okay, now I can get a big private equity guy who will then help me run the company more professionally. Right? So this could be the good playbook. Perfect. So we've understood the landscape of venture capital funds. Now let's look at the structure of how these funds actually operate, right? So you've got a fund, which is the piggy bank here, right? The blue color bag is your fund. Now, where does the money in this fund come from, right? You cannot generate it automatically. So the money in this fund is actually invested by a clutch of individuals or institutions. Now, these individuals and institutions are called your limited partners. They will, so for example, all of you guys, okay, I come to all of you guys and say that, hey, I'm starting a fund called Siddhant's Venture Capital Fund. I need money. I get all of you guys to invest, let's say, 1 crore in my fund, okay, and we've got almost about, let's say, 15-20 people here. So I get 20 crores in my fund, and that is the blue bag that is here. And all of you guys will then be limited partners. What will I do with the fund? I will then go ahead and invest it. Invest in startups like, let's say, a Viva, which is a dips and sauces player, something like a Storia, Bira, or a Doxy. Right? Just some examples of the portfolio companies that we've invested in at Sixth Sense. Who will make all the decisions? Let's say I start a Siddhant Gupta fund. Now I am the face of the fund. I will be leading the fund. So I will be something known as a general partner, right? Who will then take all the decision in terms of managing the fund, deciding where to invest, take all the investment decisions and call all the shots. This is how a fund is structured. This is what a venture capital fund is all about. Is this making sense? Okay, if this is making sense, let's get on to the monetization bit of it. Then how does a venture capital fund earn money in the first place, right? So we start with the blue bag that is there. We know limited partners, we know employees, and then you have the startups that we are typically investing in. Now, the limited partners, it all starts with the money that I'm getting in from the limited partners. So the LPs will give me rupees 100 to invest. So I have 100 to invest from the LPs. Now the 100 is there in my piggy bank, 100 is there in my venture capital fund. What will I do with this 100 rupees? I will take it and invest it in, let's say, all of these startups. Now for the sake of simplicity, let's assume that I take this 100 and invest it in a company called Storia. Just for the sake of simplicity. In real life, we will be investing this money across several startups. In Sixth Sense, we've got almost about 55 startups under our portfolio. But for the sake of simplicity, let's assume that I take this 100 and invest it in one company, that is Storia for now. Now, after 5-6 years, typically we like to hold the investment for almost about 5-6 years and then make an exit. So let's say after 5-6 years, I sell this investment for 1100 rupees. Okay, I sell this investment for 1100 rupees. What is the profit that I'm making? 1000, because I invested 100 and I got 1100 in return, right? Profit of 1000. Fair? Got it. Now, generally, there are nuances and there are different ways in which a venture capital fund is structured and the monetization happens. But in most of the cases, right, you've got the model where 20% of this profit is retained by the venture capital fund, because a venture capital fund also needs money to operate. So 20% of this 1000 is then kept by the venture capital fund. Fair? Now, the other portion is that now I know that the market value of Storia is 1100, which is why I've sold it for 1100. So every year, let's assume that the market value every year, right, has remained 1100, 1100, 1100. Let's say it has not changed. In year 1, I have put in 100. Year 0, let's say in the first year I put in 100. After that, every year, the market value has remained 1100. Let's assume it has remained the same. And at the end of the 5th year, I sold it. Now, every year, what I will say is that, hey, I'm managing this investment for you. Pay me something called as a management fee. So 2% of the assets that are under management. So assets under management means Storia is an asset under management for me. I've taken 100 from an LP, invested it in Storia. Storia becomes an asset under management. 2% of the market value of assets under management will be the management fees that I will charge every year. So 2% of 1100, which is the market value, is 22 rupees, is something that I will be charging as a management fee every year. So typically in year 5, after I have exited, right, I have two things. Every year I will have a management fee that will be constant. In the last year when I'm selling, I will have two things. The management fee of 22 rupees, which I'm going to charge every year, plus I will also have 20% of 1000, that is the profit that I'm making, right? So 200. So altogether, I have got 222 rupees as a fund, that is the earnings. How much will I distribute to the LPs? How much will I distribute to the LPs? So to remember, to just revise the facts, I've taken 100, put in 100 in Storia, I've sold it for 1100 rupees, I've made a profit of 1000. 20% of that profit, that is 20% of 1000, 200 is what the fund keeps. 2% of 1100, that's the market value, that's the management fee, is what the fund keeps. The rest is distributed. How much will I distribute to the LPs? Anyone?
80 rupees plus 20.
Tell me the exact number. How? 700 is not right. Tell me the exact number. How much will I distribute to the LPs?
990.
No. Quickly. It's maths. No. So 872 is wrong. I took in 100. How much inflow did I get? 1100. How much did I keep for myself? 2% or 20%, that is 20% of 1000, that is 200, and 2% is 22 of 1100. How much does this come to? No, 778 is wrong, 978 is wrong, 878, right? 1100 minus 200 minus 22. You guys told me 778, you guys told me 978. Is this that you guys didn't want to tell me the right answer at all? So 1100 is what I get. I distribute 22, I keep 22 as management fees. I keep 200 as the profit share. The remaining is what I distribute. That is 878 goes to LPs. Now what is the return that the LPs are getting? So they have given 100 and they have got 878 in return. Now when you read something in the newspaper saying that, hey, an investor has made almost 10x or 9x, it is essentially this. Because this is an 8.78x return for an investor putting in money into a venture capital fund. So here almost 9x return is what the LPs are getting. And that is what you read in the newspapers. And this is how the monetization works for every venture capital fund. More or less 80-90%. There could be some variations here and there from fund to fund. But broadly and almost 80-90% of the cases, this is how it works. Any variation will then build on this. But this is how a venture capital fund is structured and this is how the monetization happens. Yes, sir.
The 20% profit you're referring to, is that carry?
That is not carry, right? Maybe if you can hold on with me for about just one more minute and I'll explain what's carry as well. Right? So now, the fund will use this 222 for its expenses, right? The fund is keeping 222. Why? Because it will use for certain set of broad expenses. The first one is the carry for senior employees. Now what is carry? It is a percentage of the fund profits, right? A fund is making a profit of 1000. A fund is making a percentage profit of 1000. Now a carry for senior partners could mean that as a percentage of the fund profit. So let's say a carry for me, because I am the general partner in Siddhant Gupta's VC fund, would mean 2% of 1000. So 2% of 1000 is how much? 20. So let's say 20 is a carry that I would give to a senior partner, and that I will give after 222. That is carry. The percentage, the profit that the fund keeps is the profits of the fund, 20% of 1000, right? So that is 200. So a fund has made a profit of 1000. Right, 20% of that the fund has retained. Now I also have a clause saying that 2% of the overall profits that the fund makes, that is 1,000 rupees, will be given to the senior partner. So 2% of that is 20 rupees. So 20 rupees is the carry that a senior partner gets, and that is paid out of the 222 rupees. Is that making sense? Right? Then is salaries, because fund will have people working there, you will have to pay salaries. So the 222 will be used for that. And then of course you need to party as well, right? So the third portion that you will use is for the admin expenses and all the party expenses that you typically have, right? Parties are a big thing in venture capital funds. So whenever you exit a deal, so you typically celebrate, and that's when, and you celebrate very well. So that's when you will have to spend for parties as well. Is this clear? Okay, if this is clear, then we'll quickly move on to understanding what is in it for all of you guys, right? Now I understand why all of you guys are building up, but let's say if, all the young guys out there, like maybe you guys are also young, but anyone who's just young in terms of the career progression, right? Anyone who's just looking to step into, let's say UG and then post that, if you guys are looking to start up or looking at entrepreneurship, this may not be as relevant. But if you guys are looking at venture capital fund, starting your own fund, looking at working in venture capital funds, this is how the lay of the land looks like, right? So you've got small, mid-size and global size funds, and then the roles are typically you start off as an analyst for about 2 years as an undergrad. So once you complete your undergrad, you then start off as an analyst in these funds. You spend about 2 years, right? From there on, you move to being an associate, where you spend another 2 to 3 years, or you do a master's, you do an MBA, and then get into an associate level directly. So one way is you start off as an analyst and then you get promoted to an associate. The other way is you do your undergrad, you do your postgrad, and then you get into a associate role directly at a fund. There you spend about 2 to 3 years, and if you're good with your skills, knowledge, you prove yourself, then you can typically join as a vice president in these funds. Now I got in as a vice president directly because I had industry experience. I had done management consulting, I had done Deloitte, I had done ISB, and I was done my CA as well. So then I got into the vice president level directly. But typically idea is that you get from an analyst level, associate and vice president level. If you do well as a vice president, you typically move on to be a principal for about 3 to 5 years. If you do well here, you then get positioned to be a partner, where you typically spend the rest of your life, right? That's where the skills and knowledge works a lot. So if you notice, anywhere from vice president onwards, your skills and knowledge matters a lot, right? And these are the typical indicative salaries. So at a small level, any analyst could start from almost about 20 lakhs. At a global level fund, an analyst will be paid almost about 40 lakhs a year, right? Analyst level, right? And typically associate will range from 50 lakhs to almost 1.2 crores, typically for the others as well. So 80 lakhs to about 2 crores, 1.2 to almost 4 crores, and then for the others as well. Right? So 2 crores to almost 6 crores. Right? So this is how typically it is at if you look at working in a venture capital fund. Right? So perfect. This is a quick snapshot. Now we'll get into the game. Right? So now I've got almost about roughly how much time do we have? If we just take a time check, quick check. How much time do we have with these guys? No capacity. Okay, but still I'll just try to keep it brief because I don't want to overwhelm you with a lot of information here. But just very, very broadly speaking, what we've done right now is that we've looked at the base, right? We looked at what venture capital funds are, we've looked at the structure, we've looked at who are the types of venture capital funds, who are the types of family offices, the corporates, the individuals, who are the guys sitting with the money, right? We've looked at all of that. We've looked at the structure, we've looked at how venture capital funds actually earn money, the monetization model as well. Now we'll get into the game and understanding how the investing process actually looks like, right? So this is the process. You first start with identifying a sector and company, then you move on to issue a term sheet, right? Then you look at diligence. So once you decide that, okay, this is the sector, this is the company, then you look at issuing a term sheet. A term sheet is basically a document which has all the terms mentioned in that, saying that, hey, I like your company, these are the terms on which I will invest, and I will issue the term sheet to you. After you issue the term sheet, you will look at something known as a diligence, where you will typically have a financial diligence, a legal due diligence, and an operational diligence. Basically, it's a detailed investigation into the startup, into the company in which I'm investing, to make sure there's nothing wrong happening, right? And then I'll take all the necessary approvals as well. After I've done all of that, I will look at finalizing all the agreements, which is the shareholders agreements, a share subscription agreement, or a share purchase agreement. Now, shareholders agreement is an agreement which will capture all the rights of the shareholders, anyone who's investing in a company. A share purchase agreement is, let's say if I'm purchasing shares of an existing company from an investor, that is share purchase. And if I'm buying shares directly from the company, that is something which is called as a share subscription agreement, right? So this is what these are what the agreements look like, right? So we'll be finalizing all of these agreements, and then I will disburse the amount, right? I will prepare memos and then issue issue orders that, hey, I'm okay, please go ahead and disburse the money, right? And I have all the press releases as well that will be leaked out, not leaked out, but released officially to the public, right? So press release will be all about saying that, hey, I've invested $10 million in a company called Procmart, and this is the rationale on which I've been investing. So you start from identifying a sector and the company, and you move on to releasing a press release, right? This is how the whole snapshot of the process looks like, right? Now, idea is, how do you then segregate it into before, during, and after investment? Did you have a doubt? Yes.
I want to talk about tranches in the previous slide.
Yeah.
When do tranches come in? So like, where the disbursement amount stage, is that where you say this is the transactional period over which tranches come?
Yeah, so essentially if you're looking at investing in tranches, this essentially will be captured in the agreement. Now what happens here is that, let's say if I'm looking at investing over 3 tranches. So in the agreement I will write, hey, I will be investing a total amount of almost 200 crores in your company, and this will be done in 3 tranches. The first tranche will be done on this date or during this period, second during this period, third during this period, and that will be defined in the agreements.
And conditional?
Yes, could be conditional on time, could be conditional on performance, could be conditional on certain other aspects as well. And if those conditions are met, that is when then I'll go ahead and disburse the amount. I will not be doing a separate agreement every time for each tranche, because all of the 3 tranches are captured in the initial set of agreements only. Yeah, now idea is to divide this into a snapshot of before, during, and after investing, right? And we'll start with 101, before investing. Right? Quickly, we will start with preparing a warm and a hot list of sectors. We will evaluate the sectors and we will assess the company. This is what we will do before investing. That is identifying the sector and identifying the company. Now, how do we go about doing this? Think of all of you guys to be an individual called as Kaku, right? And think of all of you guys joining a fund called as India Emerge. Now on the very first day, Kaku's boss has told him that, can you prepare a list of potential sectors that we should invest in as a venture capital fund? Right, so Kaku gets to the job, right, and he starts with a simple approach. He lists down all the possible sectors in India right now, every single sector possible, right? Which are some sectors you guys are bullish about? Anyone? Consumer, yes. Which others? Clean tech, yes. Healthcare, yes. EV, yes. Mobility. Space tech, yes. Manufacturing, absolutely. We'll be covering a lot of it in the lead session today. So my point is that all of these sectors have a promise of their own, right? Some sectors like clean tech, you've got space tech. A lot of these sectors have promises of their own. Now the question is that, do you have so much time to be listing down all the possible sectors, evaluating each sector in depth? Obviously not, right? We cannot evaluate each sector in depth. We cannot list down all the possible sectors. I mean, we can list down all the possible sectors because you've got ready reports that give you. But do you have time to evaluate each sector in depth? You don't, right? Which is why you have to then sit and prioritize. Categorize the sectors as excellent, good, and average. Right? Typically then the excellent sectors become your hot list, the good sectors become your warm list, and the average sectors then your cold list. Idea is to focus on the excellent sectors, that is your hot list, and then maybe look at the warm list if you've completed the hot list, and then cold is something which you typically will not even have the time to look at. Alright, so now this is how it essentially works. Now, what if I tell you I've got something cool for you, right? Something cool essentially which gives you a structure of evaluating this with 98% accuracy, right? And that is what I call as the OpSpot matrix that we have. A signature, first of a kind matrix that we've developed. A patent has been filed for this because this is something we've originally created, right? And you guys are typically one of the first few ones to be actually knowing about this. The ones who've listened to me at institutes and in my online sessions. The OpSpot matrix, right? A matrix which will help you look at your own startup very, very critically, help you look at identifying and evaluating investment opportunities, writing investment thesis and preparing memos. Now, even when you're starting up and looking at building your own startups, if you want to think through as an investor, okay, is my startup investor friendly? How will investors think through of my startup, right? So if you want to apply this matrix to your own startup as well and think through it critically, it can be very much useful as well, right? So to write investment thesis, prepare memos. If you're looking to sit for venture capital roles as well, it will help you prepare for investing interviews, and it can be used by anyone with curiosity. Right? So this is what the matrix is all about. Right, so let's get to the OpSpot matrix, right, without wasting further time, right? So what is the OpSpot matrix, right? It starts with a fundamental question of how big can the sector get. Now again, to repeat, how big can the sector get? here the grammar is very important. How big the sector is not relevant right now, right? Contrary to popular opinion, someone tells me I'm investing in a sector which is worth 1 lakh crores. To me, it does not matter. It might sound as a counterintuitive view, but the reality is how big the sector is currently is irrelevant. What is relevant is how big can the sector get. Because if a sector is potentially small now and if it can get very big, that's where the growth opportunity lies, right? Because if the sector cannot get very big, and let's say if the sector is right now very big and it cannot get very big beyond that, which means that in that sector, you can only grow by taking share from others. Let's say a sector is worth 1,000 rupees right now, and let's say tomorrow it can maximum get to 1,100 rupees. So the room for growth is only about 100 rupees. I cannot grow beyond 1,100 rupees in the sector because the sector cannot grow beyond that. So which means that for me to grow, I will have to take market share from players who are already in that space, which means it is a zero-sum game, which means that it will not give me exponential returns even if the sector is big, which means that I pass it. Are you getting it? A sector cannot get very big, it is capped. Now, in order to grow in that sector, I can grow only by taking market share from the other players. And which is why this will not give me exponential returns. Is it making sense? Yes. Yeah, perfect. So which is why this is a pass for me. Now, if a sector can get very big, right? If it can get very big, then I will go ahead and start listing down the potential companies. I say that, hey, this is a great sector, it is an excellent sector, and let me list and classify each of the companies. Now, how do I do that? I do it in this way, right? I start with something known as a laggard. Laggards are companies which are potentially not growing as fast as the sector. A sector is growing at 10%, laggards are potentially growing at almost about 5%. Nothing wrong, but then not capturing on the sector growth. Hey, the sector is growing at 10%, why are you growing at 5%? Right? You are typically not capitalizing even on the sector growth. So for me, this is a pass. Then there are something known as retainers. Sector is growing at 10%, the company is growing at 10%. Good, but not great, right? Because we are ambitious, we want to grow and we want to look at exponential returns, right? So the sector is growing at 10%, the company is growing at 10%, you're capitalizing on sector growth, that's it. So, okay. What is important and what is interesting for me is gainer. Sector is growing at 10%, I am growing at 40%. And that is where the opportunity is. As founders, as all of you guys as founders, slightly more mature founders, slightly younger founders, anyone who's even looking at evaluating investment opportunities, you should strive to be the gainer. You should strive to actually invest in gainers, looking at where the gainer is, right? Even for Pawan, in fact, Bauer, right? I think the idea is that you should look at how do I be a gainer in this field of new age education, right? I don't want to grow as fast as probably the education sector. I want to outperform the education sector in some form and shape, right? So typically, how do I be the gainer in this space? And the gainer will then have a trend, right? You need to then depict a certain trend, right? So I pass a laggard retainer and then I look at trends for gainers. Right? One trend that is playing out in India is the unorganized versus organized trend. A whole set of unorganized players are being organized into an organized form of a business. For example, think of the spices industry. Unorganized players, I'm organizing them into a single spices brand, right? So that's where the industry outperformance will come, because spices industry is growing, I will grow with the spices sector. At the same time, the share of all the unorganized spices players are also coming to me. So the unorganized share is coming to me, plus the spices industry is also growing, and that is resulting in sector outperformance. The other trend that we are seeing is in innovation. That's where even schools like Bauer sits, for example, right? You're looking at innovating education altogether. You're looking at a new channel of delivery. You're looking at a new form of delivery. You're looking at new forms of content, right? New products, new channels. So essentially what is happening is this share of traditional schools is then shifting to something known as a Bauer right now. Let's say shifting to the new age schools, right? That is coming. Plus you're also growing along with the education sector. So that is resulting in industry outperformance. So the education sector, let's say, is growing at 10%. But schools like Bauer, the new age schools, let's say Bauer, Masters Union, Mesa, all of these new age schools, they are typically growing faster than 10%. All of them. Why? Because the share of the erstwhile legacy schools is also coming to them. And the education sector growth is also there. And that is what is resulting in industry outperformance. The other trend is import substitution. And a lot of what was being imported and sold in India is now being made in India and sold in India. Right? So the share of all the importers is now shifting to Indian manufacturers, plus the whole sector growth is also there, right? Now think of this, right? Even when there are geopolitical situations, right? Even right now, right? I mean, China is one, right? We're thinking of substituting China, but think of even something like a Pakistan now. In today's time, definitely importing and selling from Pakistan will not have any sentiment. No one will like to buy from you. If you tell someone that you're importing something from Pakistan, even any raw material, any ingredient, and selling, you tell me in today's time and age, after what has happened in recent times as well as in the past, not only the recent attacks, even the past what has happened, that sentiment is so strong that people will not view you as favorably versus someone who's making in India and selling in India. Right? So that is where the share of all the players who are importing and selling is shifting to players who are making in India and selling. Plus the sector growth is also there, and that is resulting in industry outperformance. This is the OpSpot matrix, a structure that will help you evaluate companies and sectors with 98% accuracy. Now, how do you think through this, right? This is a structure I've given you. I've told you that you should think through the sector can get very big. But while this is the science, there is also an element of art to it. Element of art in terms of how do I be mathematical about a sector? How do I be calculative about a sector? It's not only an industry report that can tell me that a sector can get from 20,000 crores to 1,25,000 crores. That is important for me. What is important is what are the challenges? Why will a sector go from 20,000 to 1 lakh crores? Right? What is the path of growth? Right? So for that, I've got an interesting perspective in terms of how do you think through sectors and how do you think through innovation. Right? So here you go. This is the first idea of how can you think about a sector growing very big. Is the audio out there? Can I play something?
Sure.
Yeah, okay.
Lots in renewable energy and clean tech. A couple of your companies are leading out there in the battery space as well as you're investing in. Do you think this is a big theme for the next decade, or is it something that's played out already?
Well, I think energy transition is a big theme. So I joined the Gates Pledge recently, and we had a 1 week off time So Gates is big on energy transition. I think he has an investment in
You guys can hear?
as far as
Can we increase the volume if possible? Anyone?
So much happening now in, say, drone manufacturing, in aerospace. So, a lot of these can be cash crops as well. Where do you see the next big opportunity?
So energy transition is one for sure. I think senior living is a big opportunity.
The way he goes about this now, see this.
The third one is the gaming user. The pace at which content consumption is happening on esports and gaming is growing significantly faster than movies, TV, old school content, for example. Senior living have very simple reasons. People used to give birth to, say, 4.5 kids per couple, not a long time ago. The replenishment rate is about 2.1. If a couple gives birth to less than 2.1 children as a society, the population will start to go down.
Which is what is happening right now,
Yeah.
in urban India at least.
Yeah, I think in as many as 19-20 states, the number is below 2.1. I think Karnataka is 1.7, I think Maharashtra is 1.6, UP, Bihar remain above the norm. But like Japan, there will be a situation in India, not now, but maybe 20-30 years from now, where there will be the average population, age of population will go up, but the elderly population will increase drastically in number. That's one reason for senior living. But I would say, more from a productivity standpoint, I think India is very well situated to become a hub, like an export hub for senior living. We can do really affluent communities for senior living, and I think our service industry, the ethos are such that we would service these seniors significantly better than our European counterparts right now.
So do you have any investments in that
Yeah,
space?
there are a couple. There's a company called Imoha. There's another one called Fastco in the UAE that we're looking at now. It's still actually an industry in a very nascent stage in India. So we look for opportunities here, but nothing significantly of scale has come about. Even hospitals focused on the elderly might be an opportunity.
Yeah, so the way he goes about thinking of the senior living space is quite interesting, right? The fact that the birth rate is falling below than average in India, which means that the population will typically start aging. Now, today, India has a very rich demographic dividend. What do you mean by demographic dividend? A younger population. Now, slowly, steadily, since the birth rate is falling below average, which means that the percentage or proportion of aging is faster than the proportion of giving birth, which means that we're typically getting older as a population, which means that senior living could have a big scope. Right? So the way you go about thinking this, that is the art, right? You look at a lot of videos, you look at a lot of podcasts, you speak to a lot of people. Probably you can also, I would also love to have a discussion on whatever you guys are building, right? Once you do that, you will then realize that, okay, how can I think through a sector can get very big? I've given you the structure that can give you 98% accuracy. Why I say 98%? Let's say for companies which are not making revenue right now, a lot of pre-revenue companies, let's say very, very early, not even pre-revenue, let's say very, very concept stage, right? Which are just building up, right? You just got an idea in your mind. So for them, you will not have numbers in terms of how fast you are growing, right? You will not have numbers in terms of how fast you might grow, right? So for them, that's the remaining 1 to 2%. But even then, there also we can apply the op spot in some form and shape, which probably you guys can reach out to me and I'll be happy to help you through, understand how you can apply that as well. Right? So this is how you can think through of how the sector can get very big. Now the other big chunk is, how do you think through innovation? Right? How do you look at innovation? And at Sixth Sense, we've done a lot of work on what is innovation for us from a consumer standpoint. And this is, I've got something which basically shows a result of our work. A work which shows that, okay, this is how we went through understanding this is what innovation means, this is what disruption means. Disruption, innovation, all buzzwords, all very popularly used words. But how do you actually think through, okay, this is what innovation is, this is what consumers want, this is the idea of the future, right? So this is how we thought about it at Sixth Sense.
Listed businesses or pretty much businesses which are mature and live the life cycle and the ability to innovate and disrupt existing businesses is very, very important, found to be noted. So I don't see them playing the disruptor role, which is so critical in a market like India where disruption seems to be the apt thing to do. Brand loyalty is at an all-time low in India, brand awareness is at an all-time high. A perfect recipe for disruption to happen in brands. So if I was Leo, if I was Sanjeev, I would be worried. I would be worried that suddenly 500,000 customers who are buying offline, who are buying in traditional stores, which is where he was famous, suddenly they moved online and they're buying from Purple and Leica. Customers have moved, companies have not. So I think somewhere the challenge of addressing the customer needs, wants, and attributes is not getting as defined and defined into existing leaders of listed companies as they should have been. Which is doing. I'm not started building categories which are very futuristic and therefore a lot more flexibility and higher growth. So if I look at let's say a software as a category, I think a Viva might do a better service than possibly what the leaders might end up doing over the next 5 to 11 because we're not even involved in that category today. Okay. So I think that the challenge is not so much about saying whether the category is growing at 10-15%. It's great, but not really as alluring as possible it was in previous. I think that the challenge is about identifying categories which are going to be relevant in the next 5 to 10 years and whether the larger entities are really driven in those categories. Are they doing really great category innovation within that fold? I don't really see significant innovation happen from the larger companies for sure. And the irony is that disruption can happen from challengers, it doesn't happen from leaders, right?
Yeah, so everything is changing. The products, the channels, Zepto, great example of channels, Zepto, Instamart, Blinkit, all of these. Products, Bombay Shaving Company, a great challenger, Jiva, a great challenger. Right, so a lot of these consumer categories that we've seen evolve over a period of time, we've tried to identify them at an early stage. We felt that at an early stage, we put them through the OpSpot. I mean, we didn't have OpSpot back then because this is something that I've developed after a lot of years of investing. But idea is that if you now apply OpSpot to all of these companies, they will potentially pass it, right? That's how, that's why we brand it with confidence and we claim it with confidence that with 98% accuracy you can actually evaluate sectors and companies, right? So you've got products, you've got channels, and then the ways of marketing as well, right? A lot of marketing is now moving to, let's say, Amazon, looking at Zepto, a lot of marketing, right? They run a lot of marketing campaigns for a lot of new brands, right? For example, brands like Go Zero says that almost 70% of his ice cream sales comes from Zepto, right? So they run co-branded campaigns. A lot of traditional marketing is now shifted to, let's say, like something like an IPL, which is now being streaming, like streams on a Jio plus Hotstar. So a lot of marketing, a lot of advertisements actually run on platforms like a Jio Hotstar, let's say during the IPL match as well. Almost 50,000, 60,000 crores worth of broadcasting rights, right? The worth of broadcasting rights that BCCI has sold, right? Idea is that to use it to market and sell it on platforms like a Jio Hotstar. A lot of marketing happens on traditional televisions as well, because even today in a lot of rural folds, traditional TVs and traditional soaps are very, very popular. But you see an emerging trend that they're shifting from televisions to over-the-top television. You see a lot of them shifting to Netflix, Jio, Hotstar, a lot of these platforms where a lot of India is now moving towards, right? So for example, even in Mumbai, earlier I had a cable connection at my home. Now we are doing up a new home. We've not even provisioned for a cable connection, right? But having said that, I come from Mumbai. There is a heart of Mumbai, a heart of India that sits in rural households where television still remains very, very popular. But slowly, steadily, you see that shift happening. And that's where you see a shift in marketing happening. You see a shift in distribution also happening. And a lot of Kirana stores are now moving, a lot of purchases are now moving from Kirana stores to your Zepto. Having said that, I wouldn't say that Kiranas are irrelevant. They wouldn't. They obviously form a lot of heart and soul of India. But you see certain shifts, you see certain movements happening. And that is how you think through innovation. Products, channels, marketing, right? This is how you think about innovation typically. And you look at the matrix, you look at these, you look at this video, what we've done together. If you look at it, you will then get a complete playbook in terms of how do you evaluate sectors, how do you evaluate investments, even for you guys as founders, how do you evaluate your own companies? Right? This is what we also covered last time, a bit of a repeat for you guys, but as I said, good for the young guys as well coming in. Right, so but idea today we'll be building up on the session after this, but for all you guys who are now looking at just stepping into entrepreneurship or looking at even venture capital funds, this can be a good playbook. Yeah, so perfect. We've covered what we'll be doing before investing. Quickly, I'll take about 10-15 minutes more and cover what we will be looking at while investing and post investing. Right, so now the 101 while investing, right? You've got a set of concepts which you should 100% know. One is the concept of pre-money valuation. The other is a concept called post-money valuation and cap tables. Right? These are things that you should definitely know. I'll quickly take you through a case study, and with that it will be clear as to what these concepts are. Now this is, think of it from you being a founder. Okay, how will you look at valuation? Now Mr. Anda is an investor, right, who comes in and looking at investing in a company called Crocky Limited. Crocky Limited is a shoe company. Okay, the company has 10,000 shares, 80% are with the founders and 20% is with a VC fund. Right, this is how the I think there's some lag here. Yeah. So this is how the table looks like, right? So 10,000 shares for Crocky Limited, 8,000 are with the founders, 2,000 are with a VC fund right now. So 80% founders, 20% with a venture capital fund. This is called the cap table, a table which has all the shareholdings laid out, right? So this is what you call as a cap table. Now this is before Mr. Anda has put in any money. So it is called as a pre-closing cap table, right? So Anda has not put in any money into the company yet. So this is called as a pre-closing cap table, right? So just to remind you, what we are doing here is Anda is an investor looking to invest in a company called Crocky Limited. The shareholding is 10,000 shares, 8,000 are with the founder, 2,000 is with a VC fund. And before Anda is putting in any money, this is the shareholding structure, right? So this is what the shareholding looks like right now. It is called the pre-closing cap table. Now Anda believes that the valuation of the company should be 10 lakh rupees. Anda believes that the valuation of the company should be 10 lakh rupees. Right? And the company says, okay, we are okay with a valuation of 10 lakh rupees. Now the 10 lakh valuation is before Anda is putting in any money. Right? Since this is the valuation before Anda is putting in any money, it is called as a pre-money valuation. Pre-money means before the money by Anda coming in, before the money by any investor coming in, it is called as a pre-money valuation. So a pre-money valuation is 10 lakh rupees for the total number of shares, that is 10,000. Fair? Right? Now at this valuation, Anda says that I will put in 2 lakh rupees. He says that, hey, I'm ready to invest in Crocky. The valuation of the company will be 10 lakh rupees. That is the pre-money before I come in. Now I will come in and put about 2 lakh rupees in the company. Fair? Clear with the facts? Now if this is clear, then answer a few questions for me, right? What is the pre-money valuation per share, right? With all the facts that I've given you, 8,000 with the founders, 2,000 with the VC fund, right? And the pre-money valuation is 10 lakh rupees. What is the pre-money valuation per share? 100, right? That is correct, because your pre-money valuation in total is 10 lakh rupees. The total number of shares that you have is 10,000, right? So essentially the pre-money valuation will be 100 per share, right? 10 lakh company valuation, company shares are 10,000, so 100 per share is a pre-money valuation. Fair? Clear? Now, we have the pre-closing cap table, pre-money valuation, we have the pre-money valuation per share as well, right? So now tell me, how many shares will Mr. Anda get? He's going to put in 2 lakh rupees. We know that the pre-money valuation per share is 100 rupees. How many shares will Mr. Anda get? 2,000, because he is investing at a valuation of 10 lakh rupees, which translates to a per share valuation of rupees 100, and he is putting in 2 lakh rupees. So 2 lakh divided by 100 is 2,000 shares for Mr. Anda. Is it making sense? He says that I come in, valuation is 10 lakh, 10,000 shares, so per share is 100 rupees, and I put in 2 lakh, so I will be getting in 2,000 shares. Making sense? Okay. Now if this makes sense, this is what the cap table will look like, right? 8,000 with the fund, with the founder, 2,000 with the VC fund, and 2,000 with Mr. Anda. Now I have a question for you. Why did the shareholding of the founder and the VC fund not change?
Because the VC fund is not gonna sell their own fund, their own shares.
Correct. Because correct, the VC fund is not selling shares here, neither is the founder. The company is issuing 2,000 shares. So that is why Mr. Anda is getting 2,000 shares additionally. But what is changing? What is changing? Percentage holding, right? Because now the base is 12,000, 8,000 upon 12,000 is not the same. So the founder has gone from 80% to 68%. What is this called? Dilution. Right? This is the dilution. So the founder is now diluted by almost 12%. Right? Similarly, the VC fund is now diluted from 20% to 16%. Why? So the 12% and the 4% that these guys have diluted is come to Mr. Anda. So 12% from here, 4% from here, 16% here. This is how the cap table looks like. This is called the post-closing cap table, because now the money has come in. Right? Fair? Now Anda valued the company at 10 lakh rupees. He put in 2 lakh. Right? So now the valuation of the company is 12 lakh rupees, because he valued the company at 10 lakh. He's put in 2 lakh rupees. 2 lakh cash has come into the business. 2 lakh cash means 2 lakh worth of asset. So cash is like an asset, right? So any cash that comes into the business will increase your value straight up. So 10 lakh pre-money plus the 2 lakh that cash comes in is called your post-money valuation. That is 12 lakh rupees. My question is, what is the new price per share? It's again 100, right? Because the pre-money valuation was 100 per share. You put in money at 100 per share. So your post-money valuation mathematically will also remain at 100 per share. Making sense? This is what you should know when you are making the investment or when you are raising the investment, right? These are certain concepts you should very well know. Now, if you know this, right, we've looked at the 101 before investing, we've looked at the 101 during investing. Now, let's look at the 101 after investing, right? This is where the VC P&L comes into play, right? Certain key metrics, certain industry numbers that you guys should know. Now, how does a VC P&L look like, right? Before that, let's understand what does a P&L look like, right? You've got your revenue, you've got your cost of goods sold, you've got selling, distribution, marketing, employee depreciation, finance, profit before tax, tax and profit after tax. This is what a traditional P&L looks like, a finance P&L. Now, if I then give you a perspective of taking you to a costing P&L. Now, in costing P&L, you do a unit costing method, where you do revenue less variable cost of making each product, right? That's your contribution. And then you've got all your fixed costs, selling, employee, admin, profit before tax, tax and profit after tax. This is your costing P&L. Now, this has a variation in the venture capital space as well. The costing P&L is then taken over to something known as a venture capital P&L. Now, what is a venture capital P&L? You start with revenue, right? When you sell a product. Then you've got something known as a manufacturing cost, right? The cost of making that product. Then you've got the gross margin. So until the gross margin, I have manufactured the product. After making that product, manufacturing that product, I will transport it to the place of consumption. That is what my logistics cost is. So after that, I've got CM1, that is contribution margin 1. So until here, I've manufactured. Until here, I've transported the product to the place of consumption. Then I've got something known as performance marketing, because I need to market it to sell it. So after that, I've got contribution margin 2. So here I've manufactured. Here I've transported it to the place of consumption. Here I've marketed it. So these are the functional levers. And then you've got selling, employee, admin, finance, all the expenses, and your profit before tax. Is this clear? This is what a venture capital P&L is all about, right? So these are your 3 levers. Lever 1 is the gross margin, lever 2 is your contribution margin 1, and lever 3 is your contribution margin 2, right? And this typically differs from industry to industry. And how does it differ? From my experience, I have evaluated companies in snacking, footwear, beverages, jewelry, and several other spaces as well, right? So appliances as well, for example. Right? So I evaluated a company called Wonder Chef. So Wonder Chef is one of our portfolio companies, and I have looked at those companies. Now, I've got certain numbers. Now, these numbers are not for any particular company, but what I've seen happening in a specific industry. So in the snacking space, I've seen that the gross margins are 50%, CM1 is 42%, and CM2 is almost 17%. Similarly, footwear, it ranges from 55%, and then the CM2 goes to 5%. Why? Because in footwear, you need a lot of performance marketing, right? So a lot of performance marketing. So if you see from here to here, the difference is logistics. Here to here, the difference is marketing. So if you look at certain industries, the marketing is very, very high, right? So if you look at something known as jewelry, if you see, the marketing is 40%, because you have to market a lot. Every time, every other time, you have to keep marketing. Whereas in footwear, the marketing is only about 30%. So there is an interesting take. So I was speaking to Shantanu Deshpande, who's the founder of Bombay Shaving Company, and he told me that there is a fundamental difference between how a woman consumes and how a man consumes. I told them this the last time as well. So for a male consumer and a woman consumer, the difference is that a male consumer is very, very difficult to please at the very start. But once you are able to get your shaving razor to the bathroom of a male consumer, he is very lazy to shift. Right, you've got the shaving razor to, let's say, bathroom of a male consumer. I've got a Bombay Shaving Company. I will be very lazy to try a new brand. I'm okay. Oh, this is fine. This is good. It is okay for me. Right, the shaving razor is there in my bathroom. I will not switch for many, many years. On the contrary, a woman consumer is very, very easy to please. Right, very easy to get a woman to try a product, but very difficult to retain. A woman consumer will always and always keep trying for new and new things. They're very innovative in terms of trying for newer products, whether it is cosmetics, whether it is jewelry, whether even if it is a feminine razor. Right? A Bombay Shaving Company came up with something called as a Bombay, B-O-M-B-A-E. Right? Even if it is a razor, let's say a woman buys a Bombay razor, right? She will try it for, let's say, 1 year or 6 months. And then she will say, okay, let me try another brand. Or let me try some other alternatives, right? So you've got, let's say, we've got several other alternatives in terms of hair removal, right? So women will be very, very experimental in terms of trying, because, you know, let's admit it that a woman typically would take a lot more care for her body as compared to a guy. And a guy would then, guys will also take care, but the way they take care and a woman takes care are fundamentally different, right? Which is why, right, a jewelry, and jewelry is typically a women's market, right? So 40% marketing then explains for that. And this is how you look at these levers. Appliances, again, these are how the numbers stack up, right? Similarly, across beauty, luggage, pet food, apparel, bakery, we've seen how these numbers stack up. Now in beauty, the gross margin is very high, but you look at the marketing, almost 40%. Right? Luggage, again, in pet food, we don't track CM1 and CM2 because these companies have largely been profitable for us in 6 cents. So we directly look at the profits before tax and profits after tax, and which is why I put it how we've been tracking it. But for the other companies, this is how the numbers stack up, right? We don't have any bets in apparel or bakery. And again, just to clarify, these are not numbers pertaining to any company, but just broad industry-based numbers that I've seen from my experience, all right? So this is how it stacks up. So different industries, different numbers, and this is how the venture capital P&L looks like. For all of you guys looking to found or looking to set up startups or looking to set up companies, the way you can think through your P&L is this, right? If you're looking at a consumer company, or even if you're not looking at a consumer company, the way you should think through is are the functional levers of how I can look at each aspect in detail. How I can look at optimizing gross margin, optimizing contribution margin 1 and contribution margin 2. Right? So this is how you can think through it. Perfect. So we've covered right from evaluating sectors, that is the OpSpot matrix, before investing, during investing, and after investing. I will quickly end the session with taking you through certain trends and trajectories that we've seen across India and the globe in terms of investing. Right. So the first trend is the funding trend in India in 2022 versus 2023 and 2024. Now the notable trend is that across the world, right, you've seen a dip from 2022 to 2023 in funding, but then 2024 has been a year when the funding has been revived. Right now, from here to here, 2022 versus 23, there were certain sectors which traditionally dipped. Right, so certain sectors like, for example, consumer tech. Right, versus 2020. So look at this as 2022 versus 2023. So consumer investments in 2023 were just 30% of what they were in 2022. So very heavy fall in the investments that went in consumer tech. Similarly, in fintech, almost 50% drop in investments. So consumer fintech investments in 2022, let's say if they were 100, in 2023 they were only 50, right? And then there was a dip in software and SaaS investments as well. Then there was a dip in electric mobility, but there was one sector where the investments increased even if the total investments fell. So if you look at 2022 versus 23, the total investments have fallen from 501 to 313 billion dollars. Right, but there was one sector where the investments did not fall. Which one was that? Any guesses? Yes? Health? No. So health would be more on consumer tech, where the investments have typically fallen. FMCG is again consumer tech. It is generative AI, where the investments increased by 17x in spite of the overall investments falling. Then how is the trend from 2023 to 2024? Let's look at that, right? So 2023 versus 2024, consumer tech has revived. Right, it has increased by 2.3x. Fintech still continues to fall. Software and SaaS is reviving. Electric mobility is reviving. And generative AI is continuing to grow. So looking at these trends can tell you where the opportunity could be, right? So just an added perspective, right? And then an interesting graph, right? If you see the number of deals which have been split by size, so the darkest one is a small size deal, these are the medium size deals, and this is the largest size deals, right? If you see that the smaller bracket has been increasing, right? So number of small size deals are actually increasing, and these are not by small funds, these are by some of the largest firms in the world. Tiger Global, SoftBank, Sequoia, Axel, Lightspeed, Elevation, Nexus, all of them have typically had the small size buckets increasing, small or the mid size bucket increasing, which means that small and mid size deals are actually here to stay. A lot of these funds are looking at diversifying into many companies and looking at investing slightly smaller amounts and not large amounts. And which is where the relevance of these small size deals and venture capital is here to stay in India for the next 10 to 15 years. Right, so this is an interesting perspective that I had got. And then the global story, right? Typically, obviously, this is the graph that I drew until the June of 2024. And then I saw that India is almost at $6 billion versus at $77 billion. Certain top sectors that came out were generative AI, electric vehicles, again, very much believable, and electric vehicle batteries, right? These were certain sectors that were the top investing sectors across the globe, right? 83% went into manufacturing, SaaS, rest went into e-commerce businesses. Right, and then 12th, so Bangalore typically ranks 12th across the world in terms of investable cities and cities where most of the investments have flown, and in India it is the number 1 VC city, but overall it is 12th across the world. Right. Also, just towards the end of the session, I'll just take about 5 minutes or so to just wrap this session up, wrap this masterclass up, to just give you a perspective that every idea, okay, starts very young. Right? An idea is not born overnight, and everyone starts very young, right? I showed this video to the lead students last time, but for all you guys, just give you a perspective that everyone starts very young, right? You don't have to believe that, okay, I will start something today and grow into a Mukesh Ambani or an Elon Musk tomorrow. It does not happen that way, right? Everyone starts young, and here is why.
To a California company that provides online access to information about cities around the country. Everything from where to eat and how to get around it. The company's chief engineer and founder is 27-year-old Elon Musk. And how were you going to start this company? It's a classic Silicon Valley story. Before there was a vintage Jaguar and 6-figure salary, a cute dog, and a nice house to share with some pretty girlfriends, there was the $200 a month office with a leaky room.
It was just a nasty place to be married. And I lived in it too, and showered at the YMCA.
Take us back to when you really started off this.
Well, that was the summer of '95. I had no money whatsoever. I was working, doing research in Silicon Valley on a completely different subject.
So you remember he had no money and then he started off. From then to now, so everyone starts very, very young. Can you imagine these Elon Musk? He looks older than he looks now actually. I don't know how, but then for some reason he does, right? And this is a video from a pitch from one of the founders back in his school days. And I think you guys would recognize him.
Hi, I'm Siddhant Gupta from Dubai. And over my high school career, I've learned to be a sportsman, a leader, a public speaker, and more importantly, a passionate entrepreneur.
Who is he?
Now exactly.
Founder of Zepto, Adit Palicha. He applied for a school level case study, school level business plan competition back in 2019. That young. Imagine, right? From there to here, to actually growing to be a founder for Zepto.
But yeah, we used to, I think as kids, both of us had dads who were engineers, sort of pushing us out to it. That's how we wanted as well. Team always outward.
Right, so the idea here is that, I mean, these are full videos. I would love to share them with you. Right, for the sake of time, I will probably share them with you, right, over email. I mean, it's not as much to show you the videos, but to drive home the point that everyone starts very young, whether it is Elon Musk, whether it is Adit Palicha, whether even it is Dhirubhai Ambani or Mukesh Ambani. Everyone starts off with an idea. The key is to stay at it, keep building, right? So for all of you guys out there who are just venturing out, 15, 16-year-olds, you will have a lot of rejections. You will have times when you feel that your idea may not work. You will feel that whether I'm doing the right thing. But the key is to just to stay at it, right? In my college yearbook, I said that just go with the flow, keep a smile and keep it simple and you should be fine. Right? So that is what I will leave you guys with, right? That's the end of the masterclass for today. I mean, there's a lot more that I can keep speaking on and keep telling you about. But since I've been given 1 hour and I've, I think, well past taken more than 1 hour with you guys because I just wanted to make it complete. But the idea is that venture capital is a beautiful space and it's going to be relevant for the years ahead. Whether you get into startups as a founder, whether you get into startups as an employee, or whether you look to start up venture capital funds as well, or join a venture capital fund as an employee or an investor. So either ways, that will be it from my side today in terms of taking you through the journey of private investments, taking you through who am I and how it's been for me over the years, right? So I hope you guys enjoyed it. If there's any question, please feel free to reach out to me either on email, Topmate, LinkedIn, whatever platform works for you guys, and I'll be happy to help you guys. Right, so thank you very much and wish you all the very best. Yeah, great, thanks. I hope you found value too.
Yeah, of course. How was the lead?
Good. So essentially, the lead is running